A lot of people who Betfair trade tend to back at low odds. For example, staking at odds of 1.1 for a quick 10% return on your stake. I think the biggest reason most people lose on Betfair's exchange is due to their psychology. There's just something about money which makes a person's decision making deteriorate really quickly. People tend to want to win a lot of money, but in the process not risk any money. And unfortunately, with trading, and most things in life, it isn't as simple as that. You have to take risks in order to get places in life. In a betting and trading context, this leads people trying to buy money. Trying to buy money is backing certs for a guaranteed win with very little risk. An example of this ideology in action is backing a team that's 2-0 up with 20 minutes to go at odds of 1.1 in an attempt to get a quick 10% return on your stake. I'm sure you're all aware of this type of betting and may have even done it at some point in the past. The issue is it doesn't take too many attempts of implementing a strategy like this before it goes all wrong and the other selection of the market coming back from nowhere, making you lose your trade and your entire stake. Really short odds selections are going to win a lot of the time because the odds are somewhat reflective of the actual percentage chance of the selection going on to win. The issue is the big losses tend to outweigh the tiny little wins you gradually get over time. There is an issue of people backing at really low odds, from backing at 1.01 and upwards. In this video, I'm going to explain why backing at low odds is a bad strategy, both in terms of betting and trading. I believe it comes down to two main factors: the fundamentals of betting odds on an exchange and variance. On Betfair's exchange, you can back anywhere all the way from odds of 1000 down to 1.01. In terms of percentages, this breaks down into backing a selection that has a 0.1% chance of winning, all the way up to a 99.0% chance of winning. On the exchange, there are 350 odds increments that you can bet at. These are referred to as ticks. The difference between the ticks isn't equal across the entire market. For example, there are 100 ticks from odds of 1.01 to 2.0, and then there are 250 ticks from 2.0 up to 1000. There is in fact crossover points at certain intervals across the betting odds. This is where the tick value changes. For example, at 2.0, odds below 2.0 are in 0.01 ticks. So for example, it goes 2.0, 1.99, 1.98, 1.97 and so on, all the way down to 1.01. But above 2.0, the ticks are in fact in 0.02 increments. So it goes 2.0, 2.02, 2.04, all the way up to odds of 3, where again it changes increments into 0.05. And there are multiple of these crossover points all the way up to odds of 1000. So why am I telling you this? What does all this mean for backing at low odds on Betfair's exchange? Well, firstly, let's look at it from a trading perspective. When you're trading, you are both backing and laying the same selection and profiting regardless. If you're trading at low odds, the increments are obviously going to be in 0.01s. So for example, if you was using £100 stakes to trade, each tick you would earn £1 trade profit if the market moves in your favour. If you backed at odds of 1.10 and then laid at odds of 1.09, you would have a £1 trade profit which can be hedged out across all outcomes. So why do I think this is bad value? Well, ultimately, if you did this trade at higher odds, say backing at 1.9 and laying at 1.89, you would get the same £1 trade profit. So what's the difference here? That's just the same profit on the trade. There's no difference there. Well, in fact, there actually is, because if we turn the odds into implied probabilities, so percentages, we discover something important. So firstly, if we changed odds of 1.10 into percentages, we get an implied probability of 90.9%. 1.09 becomes 91.7%, and for the higher odds example, 1.90 becomes 52.6%, and 1.89 becomes 52.9%. Can you spot the key difference? Compare the difference between the implied probabilities between the two ticks of the two trades. In the low odds trade, there's a 0.8% difference in implied probability between the two ticks, and in the high odds trade, there's a 0.3% implied probability difference between the two ticks. This is fascinating because in order for you to win the same amount of money from these two trades, the percentage the book has to move in your favour for you to profit is actually more than double in the low odds trade than it is in the higher odds trade. And as you can see in this graph here, showing the implied probability differences between all the tick sizes from 2.0 to 1.01, the implied probability difference between each tick increases the shorter the odds go, making it worse value to open a trade at lower odds. Because to move down ticks, the book has to move in your favour more. So it'll take longer for this to happen, of course, and your position will be open for longer, putting you at more risk to win the same amount of profit. To explain this in more detail, let's assume we're using a trade that is benefiting from time decay. So for example, if a football game is 0-0 on the 70th minute mark, the odds of under 0.5 goals might be 2.0. As long as there's no goal from the 70th minute to the 90th minute, the price of the under 0.5 goal market will gradually decrease from 2.0 all the way down to 1.01 by the 90th minute mark. If we were trading at any point during this game, let's have a look at a couple of scenarios. If we opened our trade with a back bet at 2.0, there's an implied probability of 50% chance of this occurring. If we wanted to trade out by laying when the outcome has become 10% more likely, so a 60% implied probability, this equates to putting the closing position at odds of 1.66. So you'd be backing at 2.0 and laying at 1.66, and this would cover 10%. And you'd have a net profit of £34 from this trade. If we did the same 10% trade but from 60% implied probability to 70% implied probability, so we're still looking at 10% more likely that the outcome will occur, we see that we'd have to back at 1.66 to open the trade, and we'd be trading out by laying at 1.43. As you can see, you'd be netting £23 of profit from this trade. From 70 to 80%, you'd be backing at 1.43 and closing at 1.25, netting £18 of profit. And from 80 to 90%, you'll be backing at 1.25 and closing at 1.11. And from 90 to 100%, you'll be backing at 1.11 and letting it run outright to the end of the game, which would be 100% of course, and you get £11 worth of profit. As you can see, the lower the odds you open your trade at, the less value you get from the same movement in terms of implied probability of the outcome becoming more likely. It's better value to back from 50% to 60% than it is from 70% to 80%. It simply isn't value to open trades at lower odds. And now looking at this from a betting perspective. When value betting, you're looking to back at odds that represent a higher probability than the outcome occurring. For example, betting at an implied probability of 51% that the coin will land on heads. I believe at low odds there's very little room to value bet. To explain this, I'm going to show you two examples where you think an outcome is 3% more likely to occur than the odds suggest it is. One example at low odds and one example at higher odds. Okay, for the lower odds example, if you were to bet at 1.15, this selection has an implied probability of 87% chance of winning. If you think that the outcome is 3% more likely to occur than the odds suggest it is, then you believe that it has a 90% chance of winning. On Betfair's exchange, 90% implied probability equates to odds of 1.11. So you'd want to place this bet, you'd be backing at odds of 1.15 and you'd win £15 if the bet comes in, using £100 stakes. And if you really think that the odds should be 1.11, remember 90%, this means that you should have been expecting an £11 win from placing this bet. So you should have expected an £11, but you've actually got a £15 win. So you've got an extra £4 than what you should get, if your prediction is correct, that the outcome is 3% more likely to occur than the odds suggest it is. Okay, we'll come back to that £4 in a minute. Now let's look at the higher odds example. Let's say that the selection is priced at odds of 5.9. This has an implied probability of about 17% chance of winning. Remember, we're saying we think that the market's mispriced by 3%, so we think there's actually a 20% chance that the outcome's going to win. On Betfair's exchange, a 20% chance equates to odds of 5.0. So if you did back at 5.9, you would win £490 if your bet went on to win. However, if the market had been priced accurately at the odds that you thought it should be, so you thought it should be at 5.0, you should only be winning £400 from placing that bet. So you should have won £400, but you've actually won £490. That's an extra £90 of profit. This is significantly more than the £4 from the low odds example. Obviously, I'm not stupid. I do realise that this isn't taking into account the actual probability of the outcomes winning. The low odds example is far more likely to occur than the higher odds example. We're talking 90% compared to 20%. So you actually need an expected value calculator, which takes into account both the profit and the probability of your bet to work out what your average return would be from placing that bet in the long run. In the low odds example, where you're betting at 1.15, but you think it's 3% more likely that the outcome will win than the odds suggested is, then the expected value of placing this bet in the long run using £100 stakes would be approximately £3. And for the higher odds example, where you've backed at 5.9, but you also think that it's 3% more likely to win than the odds suggest that it is, using the same calculation, you get the EV, or the average return of this bet, being around £17.50. Just down to the way the odds are on Betfair, in which the tick values start to represent more and more value of the book and then less value for you. Even if you're equally right in thinking that the outcome is 3% more likely, it is much better value to place the bet on higher odds than it is in the low odds example. In fact, in the example I've just shown you there, it's almost 6 times more beneficial to place the bet at higher odds. If you are interested in expected value, please feel free to check the video I've made about it on my channel. And you can also download the expected value calculator that I've used in this video from my Patreon. You can find a link to that in the description box below. Variance is another big factor to consider when you back at low odds. The lower the odds that you back at, the less you can afford to lose. On screen now, I'm showing you a distribution of a breakdown of the losses you would expect to see by placing a bet at 1.15 on Betfair's exchange. You could lose 13 times for every 100 bets you place in order for you to still be profitable. This might sound like you got a bit of leeway there, but in sports betting, it's very variable. If we take the same example from earlier in the video, where I was betting at 1.15 and thinking that it's 3% more likely than the odds suggest that it is. Remember, you'd win on average £4 from placing this bet. So long term, over them 100 bets, on average you'd win £4. If you was correct about the odds being mispriced on each of those 100 bets. However, predicting that something is 3% more likely to occur is very hard, especially doing it 100 times. And it only takes a couple of mistakes of pricing something incorrectly for you to wipe out your entire profit that you've made from the previous 50 or so bets. You need to be precise for all of your bets because you can only afford to make so few losses over a large number of markets. Any mistake is going to get punished. If you implement a strategy backing at low odds and get off to a bad start, either through a couple of mistakes or just natural variance, and have 3 quickfire losses in a row, you're going to be £300 down and you're going to be in a dogfight just to try and break even. And as you remember, the expected value from low odds bets is very low. So if you're on £100 stakes, using that 1.15 example, if you find yourself £300 down, you're going to have to try and claw back £300 on an expected value of £4 per bet. I just think even if you're brilliant at reading markets, there's just no way you can make this profitable. There's no way you're going to get it absolutely perfectly all the time. At higher odds, I'm showing you the expected distribution of losses backing at odds of 4.0. You can afford to lose 74 times out of 100 and still be profitable by backing at odds of 4.0. This gives you so much leeway in terms of making mistakes. If you mess up 5 trades and lose 5 trades, it won't matter that much. You've still got so many trades using the same strategy to try and find the value when you're value betting. Each mistake isn't punished to the same degree as it is at low odds. Obviously, making mistakes isn't ideal in any situation, but it is going to happen when you trade. You're going to misprice things, make a mess of things, and sometimes you're just going to go on a bad spell of variance. But at low odds, all these mistakes are going to have a more disastrous effect on you overall as a Betfair trader. It's true that you can go on a bad spell of variance betting at any odds on Betfair, but as we've mentioned earlier in the video, at higher odds you're getting more EV per bet, so your total EV is going to be higher and you're going to profit more long term than low odds betting, even though you're going to win a lot more. At higher odds you can obviously afford to misread more often. In this video I was using 3%. If you've mispriced the market and it's only 1% instead of 3%, at low odds you're going to be on nothing EV. It's going to be slightly positive, a pound or so. It's just not worth placing. The market being mispriced by 1% in your favour at high odds still gives you a large amount of EV that you can work with and increases your chance of being a profitable trader in the long run. The lower the odds that you back at, the more things go out of your favour. It gets more difficult to read when the market is mispriced. Even when it's mispriced and you predict it accurately, it doesn't benefit you as much as you would expect it to. When trading, the money you make per tick is nowhere near as good as it should be, especially compared to higher odds. And the market's going to be slower to move in your direction when you're scalping, meaning your position's going to be open for longer and at more risk. So I would just avoid low odds betting and trading as much as possible. If you want to learn one of the easiest ways you can find value on Betfair's exchange, check out this video I've got on my channel, and I'll see you in the next one.